Well, this week we're reviewing the Catalyst SA Property Equity Fund. It's managed by Paul Duncan Zayd Sulaiman. The formation date was February 2005. Fund size is at 514 million rand, and the benchmark is the FTSE JSE SA listed property index. It's got a TER of 1.9%. Cobie, let's just take a step back before we get into this fund, because we were talking about, of course, the performance in 2011. Very quickly, your view on the performance that we've seen from listed property in 2012.
Yeah, I mean, Paul spoke a little bit before the break about just the great returns we've seen in this space, into 2011 and kind of into 2012. It might just be kind of interesting just to kind of looking at those 2012 returns. Look at your screen at the moment, and you'll see the returns. These are the top 10 performers in the index for the last 6 months. And you can see right at the top end there, top performer there is Arrowhead B. Paul spoke a little bit about those, and those kind of all the way down to Hyprop. The worst the worst from the top 10 is obviously Hyprop there at about a 20% return. I think most people kind of would have taken those returns. And just to show you what the worst performers look like for 2012, and there you can see those. Some of the worst performers actually achieved 10% during the period, and you can see Mirror and Hospitality B, and Hospitality A rather, and then the worst of the lot is Hospitality B, which lost minus 30% during the last 6 months.
Okay, so Paul, obviously we've got you here today joining us to delve into the philosophy behind the Catalyst SA Property Equity Fund. So tell us what that is.
Basically, it's a fund that invests in listed property shares. Obviously, the index, the universe is made up of about 31 stocks. What we're trying to provide investors with is a proxy for commercial rental income streams, and ultimately an asset class that we believe provides them with an attractive income yield with the ability to provide real growth in income over time.
Exposure to the listed property space right now, do you have a strong weighting or leaning towards any ones in particular?
Look, we obviously bottom up, so we tend to look at each individual counter separately, irrespective of their sectoral allocation. Ultimately, the decisions and assumptions we make will drive which stocks we believe are cheap relative to where they're trading in the market. As we have discussed previously, by virtue of its size and collective investment scheme rules, you tend to hold always holding a large exposure to the large caps being Growthpoint and Redefined, despite the fact that sometimes you would prefer not to have the kind of level of exposure you do. Concentration risks and concentration limits elsewhere mean you have to always have a stake in those. But effectively, what we're typically holding throughout the portfolio is around about 26 to 27 shares in the portfolio at any one time, and thereby we believe providing investors with a very well diversified exposure to both retail, office and industrial asset class or sectors within the listed real estate asset class over time.
Yes. Let's maybe look at some of the returns and just kind of understand a little bit about kind of the returns that they've generated over time. You'll see the table indicating the returns for the SA Catalyst Property Fund, and there you can see it. 12 months, 25.5 relative to a benchmark there of 27 to 26.3. You can see the figures all the way down there to 5 years, 13.4% per annum. Anything longer than 12 months is obviously a per annum number versus the benchmark there of 14.8. And let me again stress that if you take the 5-year number into consideration, inflation plus 7 did 14.9 over that period. You nearly matched that inflation plus 7 number, something you certainly would never have done out of South African equities. And then maybe just as a second point, there you can see the fund relative to its benchmark. And the blue area, shaded area, is obviously the return minus the benchmark over time. You'll see some underperformance over time, some of it, but there certainly is points, obviously, of outperformance as well. I mean, Paul, briefly, at benchmark returns for a lot of the periods, sometimes slightly below benchmark. Any comments about that, and what have you guys been thinking about, when you guys have been structuring the fund?
Look, I think there's a couple of things. I think obviously as an active manager, we are cognizant of the fact that like a Growthpoint and Redefine is large in the portfolio, but we also don't feel comfortable exposing the portfolio to 45% of the clients' funds into 2 stocks. We don't feel we're giving them the diversification, and with stock like Growthpoint tending to trade be granted a liquidity premium by general equity and fixed income investors, it's tended to perform probably slightly better than we would have expected relative to a pure property analysis, and that's hurt us, but we believe we've at least given diversification of risk through the portfolio in that way. The other issue, which is obviously sometimes a challenge with these funds in markets where are performing exceptionally strong, is you tend to receive a lot of flow of cash And in a market that's performing exceptionally well, you do have to be very efficient in how you invest that money, because you have an element of cash drag, cash earning you, sort of 3 to 4% on a 12-month rolling basis in a trading account, versus the sector doing 20%. There's a significant amount of cash drag. So you're trying to manage both the diversification without giving too much concentration risk in these large caps, despite their position in the benchmark, at the same time also managing flows that tend to follow an asset that is performing exceptionally well, and thereby remain fully invested at all times to give them that proxy for commercial rental income streams.
Paul, we often see that in a bond portfolio that different bonds with different maturities, etc., are very highly correlated. Do you have a similar problem in a property fund where your sort of ability to pick one stock relative to the other might be diminished because they all move sort of in the same direction and in the same magnitude? Or is there enough opportunity to spread your bets?
Look, I think if in a perfect world where all stocks were similar market cap weighting and liquidity, there's enough variability in the sector to deliver active outperformance. When we have the sort of circumstances we have in the South African sector, as we've spoken quite significantly about, it does become quite challenging. The correlations are not as high as one would expect. The big drivers of returns is ultimately quality of portfolio, quality of management, the sectoral exposure that a particular property company has, and the quality in that particular sector. And once you compound those differences over a 3 to 5 period, the variability of returns can be very, very significant.
So Paul, before we wrap this up, your last question, are we going to see the kind of returns that we've seen over the past, say, 5 years, where we've seen inflation plus almost 7% return for this fund continuing, or would you be concerned? If you had to have a 5-year view on this fund, what would you say? What type of returns are you targeting? And give us an idea of income distribution returns.
Unfortunately, returns are never in a straight line, but where we're standing right now, based on pure property fundamentals, I believe listed property is a 12 to 13, 14% total return investment. In the shorter term, despite the fact that rates may remain low for longer, despite the fact we have significant support for our bonds with inclusion in various global indices, if bonds and interest rates remain low, that's supportive of share prices. But I would caution that based on a 12-month historic return of 26%, that our returns over the next 12 months are likely to be not as significant as that. And I would be guiding towards the lower end of that 12 to 14% 5-year expectation.